Hello and welcome. Rahul, you're watching me on my YouTube channel, my talks, and if you're watching me consistently, welcome back to my channel. See, whenever I come in front of you, I have a purpose. I want to instill positivity and disseminate some valuable knowledge. You know, whenever you are applying your time in watching something valuable, you should get that valuable resources and information so that, whenever you are aspiring to become someone else or if you're striving to make some money, you can use these useful knowledge, as a tool to sharpen your skills, to sharpen your knowledge. Whenever you will go in market, you will see that people who have knowledge, who have ability to do something, some kind of astuteness, or extraordinary ability, who can show, who can reflect, they only are given chances. Otherwise, a lot of people are not able to make their livelihood better. They are hand to mouth, they are not able to find better jobs, and if you will have better jobs, you will certainly be able to strive for a better future. That is what I want to provide you all the time, and most of the time I want you to gain self-confidence. Self-confidence is the key all the time. I trade that, and most of the time, if you inculcate a habit of assimilating more knowledge, automatically your confidence will grow, because the person who have knowledge, they will certainly try to express themselves, they will certainly try to take opportunities, and they will execute their actions in such a way that will reflect in results. The results will be perceptible, the results will be proliferating if they have knowledge, if they have right standard of thinking and right intellectual ability. That is what I want to give you. And finance, banking and finance, these are the things that you should know exactly. At least personal finance, if you're knowing exactly how to manage your assets, that will be one of the best. And if you have certain knowledge of, you know capital market or financial market or money market, you will certainly be able to perceive exactly how instruments are traded. you know Instruments are the things which gives you right. That is what I want to tell you. So all these things, information, if you have, you will certainly be able to make your position, because I have given information on all the things almost. How to start your business, your MSME business, how you want to get your loan done. I have talked about retail loans, I have talked about MSME loan, I have talked about even corporate loan, how they are evaluated. These all can be done. How you can take your private limited company to public limited company, I have told about that. How will you raise fund from angel investors, from high net worth individuals, from how can raise from pool of money, from other person, high net worth individuals, and all these personalities who are able to take a stake in your business. And have talked about how you can get enlisted your company, on SEBI, on the stock market, how you can make it public, how many directors are needed, how many promoters or shareholders can exist in private limited company and public limited company, how you can transform it from an MSME. I've talked about it, what could be needed to make your company registered. I have talked about all that. So if you want to get some knowledge, you can visit my previous video and you can watch that. But having all this knowledge, and if you don't have knowledge about markets, what kind of financial market is available to you, then that knowledge will be sought. Then you should know exactly what are the available markets where you can use your your exercise your mental ability to make some money. Because if you don't be facilitate the avenues, how can you get opportunities, how can you leverage your skills. So that is why today I'm going to talk about financial markets and money market and capital market. What are the tools of it, what are the instruments of it, how it functions. See, financial market is an avenue where sellers and buyers meet. If you have excess of money, you can meet the deficit obligations, and for fulfilling that, financial market exists. And there are two types of subset of it. One is money market and one is capital market. In simple terms, the instruments which are traded for less than 1 year, or the investment that you do for less than 1 year in financial market, that are classified into money market, and they have its instruments and tools. I will be talking about it later. But for more than 1 year, if instruments are traded or invested, your money, that will goes to capital market. Simple definition. How it calls capital market, how you call it money market. And what is the tools? What are the tools of money market that you have to know? Treasury bills, certificate of deposits, commercial papers, and call money and notice money. These are the parts of money market. So what are treasury bills actually? Treasury bills are mostly and actually governed by RBI. RBI issues treasury bills on behalf of government. Treasury bills are in India especially are of 91 days, are of 182 days, and then 364 days. There are three types of treasury bills. These are the government securities. These are traded weekly, on private market by the RBI. These are governed by RBI. So whenever government wants money from you, from real investors, they will issue treasury bills for 91 days, for 182 days, and 364 days. These are short term, because less than 1 year, short term instrument. They will raise some money from you, and instead of that, they will give you a face value where you can earn. They will give you, subtracted value, less than face value. They will issue that treasury bill to you. Suppose its price face value is 100, they will issue it to 94 rupees per per instrument. And if you will sell, again they will buy it. So suppose you are selling it, you will get it face value at 100. So what you are getting the difference price, the spread. That is what is your benefit. So government, if they want to raise money for short period of time, they will issue treasury bills, and RBI will sell on behalf of government. So treasury bills are very useful for bank events. Banks buys it in order to fulfill their SLR, a statutory liquidity ratio, which has been given a standard, that this percentage of you have to maintain it in cash or in golds or in government securities. They have options. That is why they buy. And if government wants to, also control liquidity in the market, they will sell government securities, and they will raise from the markets as soon as possible in short period of time. So government securities are traded in this way, and banks also participate in that. And institutional investors also participate in that. Sometimes retail investors, so RBI, they are given a new platform, a new channel, RBI retail. There you can also invest in government treasury bills. So these are the treasury bills that you knew, and how SLR's statutory liquidity ratio banks use to maintain that. You also knew about that, SLR. And what is repo and reverse repo? These are also part of money market tools. Actually what happens when bank wants to raise money for short period of time, they approach RBI, and they borrows money from RBI, and they give securities, whatever securities they have bought, government securities. They give securities as a collateral to RBI, and they make a repurchase agreement on that in future date they will purchase again, repurchase it at a higher price, and the higher price will be nothing but the interest rate will be levied on that, and that interest is called repo. Repurchase agreement, repo rate. And the same when it will be inverse, when RBIs want to borrow money, they will approach bank, and bank have excess money, they will park their money, and RBI will borrow from bank, and they will lend securities as collateral to the banks, and they will agree that they will buy it at a higher price, and that rate is called reverse repo. Then bank is gaining securities and they are giving money to RBI. This is called reverse repo rate. Whatever they are earning, the bank is earning. On repo rate, RBI is earning and bank is getting the money. That is what is the difference. Another thing, these are for short-term liquidity in the market. If they will raise repo, if bank wants to buy more money, if repo will raise, they cannot borrow more money from RBI because the rate has been raised. Bank will have little margin, so they don't want to borrow money. Automatically in market, liquidity will be controlled, less money in the market. And when the same thing, if repo rate will be decreased, bank will borrow more money, so liquidity will be infused in market. So these are the control instrument used as a control open market operation, where government securities are there, and reverse repo and repo are under liquid adjustment facilities, LAF. That is what you have to understand. And one more thing is available, MSF, marginal standing facility. It is also a tool to raise money from RBI, but without collateral. There in repo rate, they were issuing government securities as collateral, but here they won't have to park their collateral. Rather, they can get without collateral at MSF, marginal standing facility, which rate is slightly higher than repo rate. That is what is the reality. And another, it has also an opposite term, STF, standing deposit facility, where excess money bank can park to RBI without any collateral, and they will get a little more, rate by the RBI. So now you understood everything, repo rate, reverse repo rate, MSF, and SDF, all together, all these things, SLR you have knew about banks, so all these things come from open market operation and treasury bills, Another is commercial paper. Suppose private or public corporates, they want to raise money for their working capital. I have already told you what is working capital and term loan in my previous video. If business want to function, you know, for their working cycle, they need money to process business. For their working capital, they need, you know, so that working capital for short term, they need money, and they issue commercial papers. All the private companies cannot issue publicly commercial papers because they are private, and exactly in my previous video I have told you that only 200 people, can be shareholders in a private company. So they use and sell commercial paper to high net worth individuals, some angel investors, some venture capitalists, promoters as well. So they sell in closed group. But whereas public limited company can issue commercial paper, you know, can issue commercial paper. So all these things, you know exactly. Commercial paper is also for short term less than 1 year. That is what you have to know. Otherwise, you know exactly bonds and debentures. I will talk about that in capital market as well because they are for more than 1 year. Especially they are 3 years debentures and bonds, 3 years to 15 years. Some goes to 40 years in government securities. And bonds are traded. Sometimes it happens. So what is actually there is no difference in bonds and debentures. All bonds are debentures, but all I will say that debentures and bonds are little different. In Companies Act, they call it all together debenture. So all bonds could be debentures as well. But there is slight difference because when it is publicly traded, this is called bond. This is called bond because it can be traded on exchange funds. It can be listed. That is called bond. And debentures for long-term money, when companies raises money for long-term, these are called debentures. Even private limited company can issue debentures. Did you understand? When it will be traded, it will be called bond. Some people try to divide it in terms of terms, but actually there is no such impact in current market. That is what I'm telling you about bonds and debentures. You understand exactly that. So commercial paper, I told you in money market, commercial paper, you understood when they need money for short period of time, they issue commercial papers, and they give you certain interest on that. That is what is commercial paper. And sometimes bonds and debentures are collateral supported. I will talk about it later because it is a part of capital market. I will talk about there. And one is call money and notice money. In money market, call money and notice money is actually when banks need for interbank, they try to raise money from other banks, interbank transactions. This is called call money. One day, for overnight they take money, it is called, for 1 day it is called call money. For overnight to 14 days, fortnight. 14 days also called fortnight. 1 days to 14 days, over 1 days to 14 days. This is called notice money. So these are the terms for interlending of the banks. When they need money, they approaches another bank to issue and lend money and to borrow money. That is called call and notice money. So you understood exactly all the things. One is called certificate of deposits. Bank issue certificate of deposits when you try to deposit your money for less than 1 year. They issue certificate of deposit. When you have deposit in bank, you get certificate. If it is less than 1 year, they issue certificate of deposits or receipt. That is called certificate of deposit. Now you understood money market altogether. Let's call about capital market. The video is getting longer. Let me shorten it. I will talk about everything. If you will tell me, I will tell you exactly what are futures, what are options, how options are traded, how future are traded, everything in detail. I wanted to tell you, but the video will be so longer that I cannot describe it all together. Because in options, there are 4 options actually. Only 2 options, call and put. But you can sell call, you can buy call, you can sell put, you can buy put, in options. These are 4 options. And what are options? How they are called obligations, how they are called rights, not obligations, how futures are obligations. I will talk about deeply everything about future and options, but when you talk about technical analysis and fundamental analysis of of all these things, indices, or if you talk about specific companies of stock of every specific companies, all this together it goes very deeply, and you have to read a lot of books. But if I will give you fundamentals and deep knowledge how options are traded or how futures are traded, I will talk about it in my next video. But capital market, I talk about it. What are there? Equity share. When you buy stock, equity share, equity in a company, equity shares are the equity shares of the company where it gives you ownership in company. It also pay you dividend sometimes. Sometimes it also pay you capital appreciation. So capital gain happens. But preferential share, it has certain preference, but it will also only give you dividend, fixed dividend. But it will have preference over share capital. Sorry, uh, equity share, because preferential shares, in the binding of the company, preferential share gets preference. They will be paid first. Thereafter, whatever asset will remain, the equity capital, equity shareholders might get, but preferential shareholders have preference. Next one is derivatives, of capital market. And in derivatives, which derivatives are the future contracts or the contracts which values are lying on underlying assets, in which future comes, options comes, swaps come, forwards come. I will talk about it later in deeply in my next video. The video is getting longer. If you understand all these things, you'll have comprehensive knowledge about market. Keep watching my next videos, and I'm guaranteeing you will have every knowledge about market, how financial market works, where to go, how businesses work, deep knowledge. In 4 or 5 videos, I'm telling you, I will make it clear altogether to you. Thank you for listening to me.